Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Andrea Guerzoni, Global Vice Chair of Strategy and Transactions at EY, to discuss the overall sentiment for global CEOs in the second half of 2023 around M&A. It is great to have you with us, Andrea. Welcome to Trade Talks.
My pleasure.
All right. Despite a volatile start to 2023 due to continued market volatility and an industry-altering banking crisis in the U.S., what is the overall sentiment for global CEOs in the second half of 2023 around M&A? Do you expect the pace of deal activity to accelerate, or are industry leaders remaining cautious in the months ahead?
I think we had a very difficult first 6 months, and the situation is not going to improve much in the second half of the year. I think the reasons why the situation was such in the first 6 months hasn't really changed much. I mean, the outlook remains very uncertain in terms of economic outlook, geopolitical tensions, high cost of capital, not a great environment for M&A.
Looking back to the first half of 2023, what sectors drove M&A transactions? Are these sectors still poised for deal activity in the months ahead, or are others expected to lead the pack?
I think sectors that showed the highest level of activity are for sure technology as usual, driven by the technology advancement in many sectors. I think it's also the area of life science, in particular healthcare. You see a lot of activity in energy, oil and gas, renewables. I think these trends will continue in the second half. And I think that also the size of the deal in the first semester was quite small. I think we will see probably more large deals in the second half, not big giga deals. I think it would be more between 1 and 5 billions. But I think it's for sure a trend towards smaller and less complex deals that will continue in the second half.
With operational efficiencies at the forefront for global CEOs, how is the adoption of generative AI and machine learning expected to drive deal flow in the second half of 2023? How are global leaders finding use cases for this technology in the deal-making process?
I think it's super interesting. I think the new technologies are really creating a different environment in terms of scouting new opportunities, understanding better the market dynamics, really analyzing data with a different pair of lenses. So both, I think, in the scouting process, in the diligence process, being able really to look at much bigger data sets with different algorithms and try really to understand quicker and with more depth what's happening in a sector. This for sure is a big advantage. I mean, we are providing our clients with this kind of technology and it's really making the difference. It's getting to grips, I think, across all sectors. Data remains a fundamental aspect of this, and the quality of data makes the difference.
The last time we spoke, we discussed how organizations are navigating market uncertainty through short-term cost optimization, as well as building long-term value through ESG, technology, and talent investments. Are these themes still a priority for the CEO's strategic agenda, and how are they driving M&A activity today?
I think it remains really the same. I think there's a lot of focus on ESG sustainability, and in the deal making becoming more and more important to understand really the footprint, the carbon footprint of both targets and combined entities. So there's a lot of efforts in terms of due diligence to try to understand the consequences of acquiring a certain asset. So that's a remain a priority for sure.
Against the backdrop of continued geopolitical disruptions, macroeconomic uncertainty, and regulatory concerns, smaller deals remain attractive heading into the second half, according to the EY mid-year M&A outlook. How are these deals positioning M&A activity for success in the coming months? How will PE be driving in smaller deal activity, especially given the slowdown in activity?
I think PE and corporates alike, I think, are getting more accustomed to the challenging market conditions. And for sure, smaller deals tend to entail a lower level of complexity, especially when you talk about bolt-on acquisitions. I mean, portfolio companies really can grow faster through this strategy. I think PE will leverage on this. They know the sectors. They obviously are very familiar with the issues, and they have capable management teams in place. And this will speed up really the deal activity in the second half. Probably 24 will be a different story, but I think for the first 6 months, the second 6 months of this financial year is going to be like that.
All right, Andrea, we appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
My pleasure. Speak to you soon. Bye-bye.